Here is something that will make your brain short-circuit for a second. A person with $100,000 in debt is in serious trouble. They lose sleep, they miss payments, their credit score bleeds out slowly, the bank calls, their stomach drops every time they open their email. That debt owns them. It follows them into the morning and sits next to them at dinner. Now take a person with $1 million in debt. They are on a yacht, not metaphorically, literally. They are refinancing, restructuring, leveraging, and building more wealth on top of that debt, while the first person is Googling how to consolidate credit card bills. Same concept, radically different lives. And the reason why tells you almost everything that is broken and quietly brilliant about how money actually works in the modern world. This is not a story about being rich versus being poor. It is a story about how debt itself has two completely different identities depending on how much of it you are carrying, who gave it to you, and what you used it for. And once you understand the difference, you will never look at a balance sheet the same way again. Let us start with the person carrying $100,000 in debt. Because most people watching this are either there, close to there, or know someone who is. This is the most common version of debt in America and in most of the developed world. It is credit cards, student loans, a car note, maybe a medical bill that arrived on a Tuesday without warning and destroyed a year of financial progress. It is the debt of regular life, the debt of trying. And here is what life actually looks like at that level. At $100,000 in unsecured debt, your monthly minimum payments are probably somewhere between $1,500 and $3,000 depending on the interest rates attached. Credit card debt in the US currently averages somewhere north of 20% interest annually. Student loans hover between 4 and 8% on the federal side, more on the private side. Mix them together and you might be looking at an effective rate of 12 to 15% across the whole pile. That is not a number. That is a slow drain. At 15% interest on $100,000, you are paying roughly $1,250 a month in interest alone before you touch a single dollar of the principal. If you pay $1,500 a month total, you are only reducing the debt by $250. At that pace, it takes decades to get out. Most people are paying the minimum, which is designed specifically to keep them in debt as long as legally possible. That is not an accident. That is a business model. Now here is where it starts to get psychologically complicated. The person with $100,000 in debt is usually alone with it. There is no advisor calling them to restructure. There is no team of accountants finding creative solutions. There is no access to lower interest rates because their debt-to-income ratio disqualifies them from the products that would actually help. The system is built to keep them paying interest, not to help them escape it. They are not too big to fail. They are exactly the right size to squeeze. And here is the cruelest part. That debt is almost never tied to an asset that grows. It bought a degree that the market may or may not value. It bought groceries during a rough month. It bought a car that is worth less every single day. It sits in the driveway. The debt stays the same size or grows. The thing it bought shrinks. That is called a liability, not in a judgmental way, in a mathematical way. It pulls value out of your life every month without putting anything back. Now let us cross to the other side of the table. $1 million in debt. The first thing you need to understand is that this number almost never shows up without a conversation. Nobody accidentally accumulates $1 million in debt the way someone racks up credit card bills. $1 million in debt is a decision. It is a document. It is a relationship between a borrower and a lender who has looked very carefully at the numbers and decided there is more money to be made by giving it than by keeping it. That distinction matters more than almost anything else in this entire video. When a bank extends $1 million in credit, they are not doing charity. They are doing business. And they are only doing it because the asset or the income stream behind that loan is worth considerably more than $1 million. Which means the person taking the debt is, from the bank's perspective, not a risk. They are an opportunity. Here is what $1 million in debt actually looks like in practice. Most commonly, it is a commercial real estate loan. A property worth $1.4 or $1.5 million, bought with 30% down and the rest financed. The monthly payment on $1 million commercial mortgage at roughly 7% over 30 years is about $6,600. That sounds enormous until you hear what the property generates. If that building has tenants, it might produce $8, $10, or $12,000 a month in rent. The debt pays itself. What remains is called cash flow. And cash flow is the thing that separates wealth from the performance of wealth. But let us go deeper than real estate because that is only one version of this story. The person with $1 million in debt might also be a business owner who borrowed to expand, to acquire a competitor, to buy equipment that produces revenue. Their debt is tied to something that earns. The interest on that debt in many jurisdictions is tax deductible. So not only is the asset producing money, the government is essentially subsidizing the cost of borrowing by reducing the tax bill at the end of the year. The debt is doing three things simultaneously. It is building an asset, it is generating income, and it is lowering taxes. The person with $100,000 in credit card debt is doing none of those things. They are just paying for the past. Now, here is where the irony reaches almost absurd levels. The person with $1 million in debt typically has a better credit score than the person with $100,000 in consumer debt. That sounds insane, but it makes complete sense once you understand what a credit score actually measures. It does not measure whether you are good with money. It measures whether you are useful to lenders. A person with $1 million mortgage, consistent payments, and a diversified credit profile looks excellent to the scoring algorithm. A person with maxed out credit cards and a high utilization ratio looks dangerous. Even if both people have the same income. Even if the person with less debt is trying harder. The system is not measuring virtue, it is measuring predictable profit. And predictable profit lives with the person who has more structured, asset-backed debt, not the person scrambling to keep the lights on. There is also something called the debt-to-income ratio. Most consumer debt products for regular people require that ratio to be below 36%. But business debt and investment debt are evaluated entirely differently. They are judged on the performance of the asset, not the personal income of the borrower. So, $1 million commercial loan can coexist with other debts in a way that $100,000 in credit cards cannot, because they are playing by different rules. Two different games with the same word on the outside of the box. But here is where we need to slow down and be honest, because the narrative of good debt versus bad debt gets weaponized constantly by people trying to sell you something. Not all $1 million debt is genius, and not all consumer debt is a trap. There are people who borrowed $1 million on a property at the top of a market and then watched values collapse. There are business owners who leveraged themselves to the hilt and then got hit by a supply chain disruption, a pandemic, a regulation change, and suddenly the asset that was supposed to service the debt stopped producing. At that point, $1 million liability is not a yacht. It is a drowning. The difference between strategic debt and catastrophic debt is not the amount, it is the margin. The buffer. The distance between what the asset produces and what the debt requires. Compress that margin enough and $1 million real estate portfolio becomes a foreclosure. Compress it a little more and the personal guarantee on that commercial loan reaches into private life, liquidating savings, retirement accounts, and anything that was not nailed down. Large debt magnifies everything. If you are right, you are very right. If you are wrong, you are very wrong. And the institutions that lent you the money will not share in your pain. They will simply take the asset and move to the next deal. This is the part they do not put in the Financial Freedom webinar. So what do you actually do if you are carrying consumer debt in the $100,000 range and watching this video, knowing that the rules of the game seem built against you? First, you stop trying to solve an interest rate problem with willpower. That is like trying to bail out a boat with a teaspoon. You need to change the math, not your mindset. What that means practically is consolidation where possible. Not into another credit product that sounds friendly but carries fees, but into the lowest rate instrument you can qualify for. A home equity line if you own property. A personal loan at a lower fixed rate. A balance transfer with a genuine 0% window that you use as a surgical tool, not a postponement. The goal is to buy time by lowering the cost of the debt so more of each payment reduces principal rather than feeding interest. Second, you separate the debt into two categories. Which pieces are shrinking in value and which pieces could potentially grow. Student loans attached to a career that is advancing can be managed differently than a car loan on a depreciating vehicle. Not all consumer debt is equally destructive. Some of it is just annoying. Some of it is genuinely corrosive. Treat them accordingly. Third, and this is the uncomfortable one, you have to look at income. Expense cutting has a floor. You can only reduce spending to zero. But income has no ceiling. The people who escape consumer debt fastest almost always have an income event, not a budgeting victory. A second income stream, a job change, a freelance project, a sale. Something that changes the monthly math dramatically rather than incrementally. This is not a motivation speech. This is just arithmetic. 100,000 in debt at 15% requires a different solution than patience and coffee skipping. Now for the person operating at the $1 million level, the advice is counterintuitively different. The danger at that level is not accumulation. It is concentration. Having $1 million in debt on a single asset is fundamentally different from having it spread across 5 assets. If one property goes wrong, one business hits a rough quarter, the whole structure wobbles. The discipline at the high end is not leverage itself. It is diversification of that leverage across assets, income types, and economic conditions. The other danger is what advisors call rate creep. Borrowing long at a fixed rate is a completely different experience than borrowing at variable rates in a rising rate environment. A $1 million portfolio financed at 3% in 2021 and now refinancing at 7% in 2024 is not the same portfolio. The math changed. The asset values may have adjusted. The cash flow that looked comfortable may now be razor thin. And thin margins at scale are where fortunes quietly unravel. The people who stay wealthy through multiple economic cycles are almost always the ones who treated their debt not as a tool of ambition, but as a liability that required ongoing management, renegotiation, and respect. Zoom out for a moment and look at what this really reveals about the economy we all live inside. There are essentially 2 financial systems running simultaneously. One for people with access to capital and asset-backed credit, where debt is cheap, flexible, and potentially wealth-building. And one for everyone else, where debt is expensive, rigid, and designed to extract maximum return for the lender. The person with $1 million in commercial debt is borrowing at 6 or 7%. The person with $100,000 in credit cards is paying 22%. Both are borrowers. The difference in cost is the difference in power. And the system perpetuates itself. The person with cheap debt builds assets. Those assets raise their net worth. That net worth unlocks more cheap debt. Round and round. The person with expensive debt services interest. That interest depletes savings. No savings means no down payment. No down payment means no asset. No asset means no assets to the lower tier of the system. It is not a conspiracy. It is just how compounding works when it runs in 2 directions at once. So here's the thought this leaves you with. The dollar amount of your debt matters less than almost everything else about it. What rate it carries, whether time is working against it, whether it is in a system that rewards you for carrying it or punishes you. 2 people. Same number on their balance sheet. One is building a portfolio. One is losing a decade. And the uncomfortable question that this raises, the one that does not have a tidy answer, is whether the game can actually be changed from the inside. Whether someone carrying expensive, unproductive debt can find a doorway into the other system. Or whether the architecture of it, the credit scores, the income requirements, the collateral demands, the rate tiers, is specifically designed to keep people on whichever side they started on. That question does not have a clean answer. Not because nobody has thought about it, but because the people who benefit most from it running the way it currently runs are the same people with the most influence over how it continues to run. Think about that for a while. And if this video made something click for you, if it reframes something you have been carrying around without language for it, the single most useful thing you can do right now is like it and subscribe. Not because those numbers feed an algorithm that rewards this channel, though they do, but because the next video builds on exactly where this one ended. And you are going to want to be there for that one.